The Federal Reserve's Overnight Reverse Repo facility, known as the RRP, accumulated over $2.5 trillion in balances at its peak in 2023, before declining substantially through 2024 and into 2025. This decline represents a significant shift in the distribution of excess liquidity that entered the financial system during pandemic-era monetary expansion. The mechanics of this drawdown, its relationship to Treasury market dynamics, and its implications for short-term funding markets constitute important structural developments worth examining systematically. This analysis addresses how the RRP facility functions, why balances declined, what the drawdown means for money market funds and Treasury auctions, and what range of outcomes different conditions may produce. The analysis will proceed in 5 parts. First, the confirmed operational mechanics of the RRP facility and its role in the financial system. Second, the documented trajectory of RRP balances and the forces driving the decline. Third, the relationship between RRP drawdown and Treasury market dynamics, including debt issuance and auction mechanics. Fourth, the implications for money market funds, banking system liquidity, and monetary policy constraints. Fifth, scenario mapping based on different paths for Treasury issuance, foreign demand, and Federal Reserve policy responses. The Federal Reserve's Overnight Reverse Repo facility allows eligible counterparties, primarily money market funds and government-sponsored enterprises, to lend cash to the Federal Reserve overnight in exchange for Treasury securities as collateral. The transaction reverses the following day, with the Federal Reserve returning the cash plus interest at the RRP rate. From the Federal Reserve's perspective, this is a repo transaction where it is the cash borrower. From the money market fund's perspective, it is a safe overnight placement earning interest backed by government securities collateral. The RRP facility was established as a monetary policy tool to help the Federal Reserve maintain control over short-term interest rates. During periods when excess reserves in the banking system are abundant, market interest rates can fall below the Federal Reserve's target range. The RRP rate serves as a floor for short-term rates by providing an alternative investment option for cash-rich institutions. If market rates fall below the RRP rate, institutions would prefer placing funds at the Federal Reserve rather than lending at lower market rates, creating demand support that prevents rates from falling further. Following pandemic-era stimulus programs in 2020 and 2021, the financial system absorbed unprecedented liquidity. The Federal Reserve's balance sheet expanded from approximately $4 trillion to $9 trillion as it purchased Treasury securities and mortgage-backed securities. Simultaneously, fiscal stimulus transferred funds to households and businesses. Banks received deposits that exceeded loan demand, creating excess reserves. Money market funds received inflows from investors seeking safe short-term returns. This excess cash had limited placement options within acceptable risk parameters, driving institutions toward the RRP facility. RRP balances grew from near zero in early 2021 to over $2.5 trillion by mid-2022 and remained above $2 trillion through much of 2023. This accumulation represented a structural feature of the post-pandemic monetary environment rather than temporary fluctuation. The facility effectively absorbed excess liquidity that might otherwise have pushed short-term rates below the Federal Reserve's target range. The decline from peak RRP balances began in late 2023 and accelerated through 2024. By early 2025, balances had fallen to levels substantially below the peak. Several documented factors contributed to this drawdown. Treasury bill issuance increased substantially following the resolution of debt ceiling constraints in mid-2023. When Treasury bills offer yields comparable to or exceeding the RRP rate, money market funds have incentive to shift allocations from the RRP facility to Treasury bills. This substitution reduces RRP balances while increasing Treasury bill holdings within money market fund portfolios. The Treasury's general account, which represents the government's operating account at the Federal Reserve, also influences RRP dynamics. When the Treasury spends funds from its general account, liquidity flows into the banking system. When the Treasury builds its cash balance through new issuance, it absorbs liquidity. The interplay between Treasury cash management and RRP balances creates short-term fluctuations overlaid on longer-term structural trends. Money market fund assets under management remained large throughout the RRP drawdown period, but their allocation shifted from RRP placements toward Treasury bills and other short-term instruments. This allocation shift reflects rational response to relative yields rather than distress. When Treasury bill yields exceed RRP rates by sufficient margin to compensate for minimal additional operational requirements, portfolio managers reallocate accordingly. The Federal Reserve conducted quantitative tightening beginning in 2022, allowing its balance sheet to shrink by not reinvesting proceeds from maturing securities. This process gradually reduces bank reserves in the financial system. The interaction between quantitative tightening, which reduces total reserves, and RRP drawdown, which redistributes existing liquidity from the RRP facility to bank reserves and Treasury markets, creates complex dynamics for assessing overall system liquidity. Distinguishing between adequate and inadequate reserve levels requires examining several indicators. The effective federal funds rate relative to the interest on reserve balances rate indicates whether reserves are sufficiently abundant. When the effective federal funds rate remains well below the interest on reserve balances rate, reserves are plentiful. When the spread narrows or disappears, reserves may be approaching levels where funding markets face pressure. In September 2019, a precursor event illustrated the consequences of insufficient reserves. The federal funds rate and repo rates spiked sharply as reserve levels fell below the threshold needed for smooth daily operations. The Federal Reserve responded by injecting liquidity through repo operations and resuming balance sheet expansion. This episode demonstrated that reserve scarcity can materialize relatively quickly and create operational stress in short-term funding markets. Treasury market dynamics create ongoing demand for system liquidity. The federal government runs persistent fiscal deficits requiring continuous new debt issuance. As previously issued debt matures, the Treasury must refinance by issuing new securities. When the total amount of maturing debt and new deficit financing exceeds typical absorption capacity, auction dynamics can show stress through declining bid-to-cover ratios, higher than expected yields, and increased primary dealer warehousing requirements. Primary dealers, which are financial institutions with obligations to participate in Treasury auctions, must purchase securities when other bidders fail to absorb available supply. If dealers accumulate large inventories due to weak auction demand, their balance sheet capacity for other activities becomes constrained. This can transmit pressure from Treasury markets to broader funding conditions. Foreign participation in Treasury auctions remained important, but showed some shifts during 2022-2025. Official foreign holdings, including central bank portfolios, declined modestly from peak levels as some central banks diversified reserves toward gold and other assets. Private foreign investor participation remained, but showed sensitivity to relative yields and currency hedging costs. When dollar hedging costs are high for European or Japanese investors, the yield advantage of treasuries diminishes or disappears when measured in hedged terms. The Bank Term Funding Program, created in March 2023 following regional bank failures, provided emergency liquidity to banks, allowing them to borrow at par against underwater Treasury and agency securities. This program expired in March 2024. Its expiration removed a specific backstop that had been available to banks with unrealized losses on fixed income portfolios. Banks with such losses face ongoing balance sheet pressure as higher rates persist, though accounting rules allow these losses to remain unrealized as long as banks do not sell the securities. Federal Deposit Insurance Corporation data confirmed that unrealized losses in bank investment portfolios remained substantial through 2024, reflecting the impact of higher interest rates on bond values. Banks holding securities purchased at low yields during 2020-2021 experienced significant mark-to-market declines as yields rose. However, the accounting treatment of held-to-maturity portfolios means these losses do not affect reported capital ratios unless banks are forced to sell. The interaction between RRP drawdown, Treasury issuance pressure, and bank balance sheet stress creates a liquidity landscape that differs from both the abundant post-pandemic environment and the pre-pandemic baseline. Understanding this landscape requires examining each component's contribution to overall system conditions. Money market funds manage approximately $6 trillion in assets as of 2024-2025. Their primary mandate involves preserving capital and maintaining liquidity for investors who use them as cash management vehicles. Eligible investments include Treasury bills, agency securities, repo agreements backed by government collateral, and similar instruments. The shift from RRP placements to Treasury bill holdings within money market fund portfolios represents substitution between two safe, liquid instruments rather than movement into higher-risk assets. However, if Treasury market volatility increases substantially, or if bid-ask spreads in Treasury bills widen during stress periods, money market fund operations face challenges. Funds must maintain ability to meet redemption requests, requiring reliable access to liquid assets. During the March 2020 market disruption, money market fund stress prompted Federal Reserve intervention through the Money Market Mutual Fund Liquidity Facility. The episode demonstrated that even perceived safe assets can face liquidity challenges during extreme market dislocations. The concept of financial repression describes a policy environment where interest rates are maintained below inflation rates, effectively eroding the real value of savings and debt simultaneously. Governments with large debt burdens benefit from financial repression because inflation reduces the real burden of outstanding debt, while low nominal rates reduce interest service costs. Creditors and savers experience negative real returns, transferring purchasing power toward debtors. Historical examples of financial repression include the post-World War II period in the United States, when the Federal Reserve maintained low interest rates through an accord with the Treasury, allowing government debt to be inflated away over time. Real returns on government bonds were negative for extended periods, enabling debt-to-GDP ratios to decline despite continued nominal deficit spending. Similar dynamics occurred in several European countries during the 1940s-1960s. Whether current conditions constitute financial repression depends on the relationship between nominal yields and inflation. During 2022-2023, inflation substantially exceeded nominal yields on short-term Treasury securities, creating negative real returns. This pattern partially reversed as the Federal Reserve raised rates through 2023-2024. However, the sustainability of positive real rates with high nominal debt levels creates ongoing tension between inflation control objectives and debt management imperatives. The monetary policy constraint emerges from this tension. Higher interest rates reduce inflation, but increase government debt service costs, worsening fiscal deficits and potentially requiring additional debt issuance. Lower rates reduce debt service costs, but risk allowing inflation to persist or re-accelerate. Central banks operating in high-debt environments face this trade-off in every policy decision, limiting their flexibility compared to lower debt environments. Historical references provide context for current conditions. The 2008 financial crisis involved sudden liquidity withdrawal from wholesale funding markets as confidence in mortgage-backed securities collapsed. Interbank lending froze as institutions became uncertain about counterparty exposure to toxic assets. The Federal Reserve responded through unprecedented emergency lending facilities. Current conditions involve different mechanisms, specifically fiscal pressure on Treasury markets rather than private credit quality concerns, suggesting different transmission channels, though potentially similar outcomes in extreme scenarios. The 2019 repo market episode resulted from a specific combination of corporate tax payment seasonality, Treasury auction settlement, and quantitative tightening reducing bank reserves. The Federal Reserve responded quickly, and the episode resolved within weeks. The episode established that reserve adequacy requires monitoring and that the adequate reserve level is higher than previously estimated. Current conditions involve a deliberate monitoring of reserve levels as quantitative tightening continues. Multiple scenarios exist for how liquidity conditions may evolve, depending on Treasury issuance volumes, foreign demand patterns, Federal Reserve policy adjustments, and fiscal developments. Scenario A involves orderly transition and maintained stability. In this scenario, RRP balances stabilize at low levels as money market funds complete their reallocation to Treasury bills. Treasury auctions continue functioning with adequate demand despite reduced foreign official participation, supported by domestic institutional buyers and price-sensitive private buyers. The Federal Reserve monitors reserve levels and slows or pauses quantitative tightening before reserves reach scarcity levels. Short-term funding rates remain orderly without the spikes seen in September 2019. Banks manage unrealized portfolio losses without forced selling. Fiscal deficits gradually moderate as economic growth continues, reducing pressure on Treasury issuance volumes. The transition from abundant to adequate liquidity occurs without disruptive episodes. Conditions required for Scenario A include Treasury auction demand remaining sufficient at market clearing yields, reserve levels staying above the scarcity threshold, no major bank failures forcing fire sales of fixed income portfolios, and fiscal policy maintaining manageable deficit levels. Indicators include stable bid-to-cover ratios at Treasury auctions, federal funds rate remaining near its target range without pressure, stable repo rates in overnight markets, and gradual rather than sharp RRP drawdown. Scenario B involves periodic stress episodes requiring policy responses. In this scenario, reserve levels decline to ranges where funding markets show intermittent stress. Overnight repo rates spike periodically above the federal funds target range, requiring Federal Reserve open market operations to restore orderly conditions. Treasury auction tail events, where securities price above the when-issued yield indicating insufficient demand, occur more frequently. The Federal Reserve terminates quantitative tightening to prevent reserve scarcity, but does not resume active asset purchases. Standing repo facilities are utilized more frequently as banks and dealers access emergency liquidity windows. Short-term funding costs increase modestly, affecting leverage strategies and dealer financing. Money market funds experience elevated volatility but no structural impairment. Fiscal deficits remain large, maintaining pressure on Treasury issuance calendar. Conditions required for Scenario B include reserves approaching but not reaching critical scarcity, occasional imbalances between Treasury supply and demand, bank balance sheet constraints limiting dealer intermediation capacity, and fiscal deficits remaining elevated without meaningful reduction. Indicators include increasing frequency of repo rate spikes, declining Treasury auction bid-to-cover ratios, wider bid-ask spreads in Treasury markets, elevated SOFR rates relative to the Federal Reserve target, and increased Federal Reserve open market operation frequency. Scenario C involves acute liquidity stress requiring emergency intervention. In this scenario, reserves decline to levels insufficient for smooth daily operations. Overnight funding rates spike sharply, transmitting to broader credit markets. Treasury auction demand deteriorates substantially, with primary dealers forced to warehouse large inventories that strain their balance sheets. Some regional banks face deposit pressure, requiring asset sales that crystallize unrealized losses. Money market funds experience redemption pressure, forcing liquidation of short-term securities and creating feedback on funding markets. The Federal Reserve activates emergency facilities, including repo operations at scale, potential resumption of asset purchases, or new lending programs. Congress faces pressure to address fiscal trajectory. The episode creates lasting effects on confidence in dollar-denominated assets. Conditions required for Scenario C include rapid reserve decline below operational minimums, significant deterioration in Treasury auction demand, coinciding with large issuance needs, bank stress concentrating in institutions with large unrealized losses, and absence of timely Federal Reserve response. Indicators include federal funds rate trading substantially above target, failed or severely tailed Treasury auctions, sharp SOFR spikes similar to September 2019 but larger, bank stock declines reflecting balance sheet concerns, and money market fund net asset value pressure. The implications vary across participants. Savers and bank deposits or money market funds face different conditions than asset holders. Bank deposit rates may not keep pace with money market yields as banks manage their funding costs. Money market funds offer competitive short-term yields but depend on orderly Treasury markets for operational stability. Real returns on savings depend on the relationship between nominal yields and inflation, which remains uncertain. Treasury market participants face a changed environment compared to the post-2008 period of abundant liquidity and Federal Reserve balance sheet expansion. Auction dynamics require monitoring as foreign official demand shifts. Primary dealers managing inventory face funding costs and balance sheet constraints. Long-term investors in treasuries face duration risk in an environment of fiscal uncertainty. Banks must manage the tension between unrealized portfolio losses, deposit competition, and lending opportunities. Institutions with large held-to-maturity portfolios remain exposed if forced sales become necessary due to liquidity needs. Community and regional banks may face more acute pressure than large institutions with more diversified funding sources. The Federal Reserve faces constrained policy space. Resuming asset purchases would expand the balance sheet and reduce fiscal pressure on Treasury markets, but could reignite inflationary pressures. Maintaining quantitative tightening preserves anti-inflationary credibility, but risks reserve scarcity. Adjusting reserve requirements or interest on reserve balances rates provides additional tools, but does not eliminate the fundamental tension between debt sustainability and price stability. What remains uncertain includes the precise level at which bank reserves become scarce enough to create funding market stress, the trajectory of fiscal deficits and Treasury issuance volumes, the pace of foreign official reallocation away from dollar assets, the Federal Reserve's response thresholds for different stress indicators, and the behavior of money market fund investors during potential stress periods. Key variables to monitor include daily RRP balance levels, federal funds effective rate relative to target range, repo rate behavior particularly around Treasury auction settlement dates, Treasury auction bid-to-cover ratios and tail sizes, bank reserve levels reported in Federal Reserve statistical releases, FDIC data on unrealized bank portfolio losses, and money market fund flows. Changes in these indicators signal which scenario is developing. The RRP drawdown represents a documented structural shift in liquidity distribution rather than a sudden crisis. Excess liquidity accumulated during pandemic-era expansion is redistributing through the financial system as money market funds reallocate from RRP placements to Treasury bills and as quantitative tightening gradually reduces total reserves. The operational consequences of this redistribution depend on whether the transition maintains adequate liquidity in daily funding markets or creates scarcity that disrupts normal operations. Historical precedent from 2019 demonstrates that reserve scarcity can manifest relatively quickly and that the Federal Reserve monitors these conditions actively with tools available for response. The current episode differs in scale and context, but operates through similar mechanisms. Monitoring the specific indicators of funding market health provides more analytical value than simplified narratives about system collapse or crisis inevitability. To summarize confirmed elements, RRP balances declined from over $2.5 trillion at peak to substantially lower levels by 2024-2025. Money market funds reallocated from RRP placements to Treasury bills as relative yields shifted. The Bank Term Funding Program expired in March 2024. FDIC reported significant unrealized losses in bank investment portfolios. Treasury issuance volumes remained large due to persistent fiscal deficits. Federal Reserve conducted quantitative tightening beginning in 2022. What remains uncertain includes the adequate reserve level below which funding stress emerges, fiscal deficit trajectory, foreign treasury demand patterns, Federal Reserve response thresholds, and money market fund behavior under potential stress conditions. The variables that matter most include reserve levels relative to operational minimums, Treasury auction demand quality, repo rate stability, bank balance sheet conditions, and Federal Reserve policy adjustments in response to funding market signals. These factors determine whether the transition from abundant to adequate liquidity occurs smoothly or with disruptive episodes. This analysis examines the documented mechanics of RRP drawdown and its transmission to related markets without projecting inevitable outcomes. We will continue tracking confirmed developments in Federal Reserve balance sheet operations, Treasury market conditions, and short-term funding rate behavior.